Hello, everyone. Again, good morning, good afternoon, good evening, depending on where you are. If you joined us during today's opening interview, then I hope you know who I am by now. But as a quick intro for those who weren't at the top event, I am Avery Bradford. I'm head of programming and events for the Female Founder Collective and the 10th House. And we have partnered with Capital One Business on this 3-week series. This is actually our final installment of the series. So, Sheneya, you are actually closing us out. We're going to end with a bang. We're going to end with a topic that we have actually never spoken about before. So I'm really excited for you all to learn about this. This is something that as founders, we need to be above and beyond aware of. So I'm really looking forward to that. The topic is maximizing cash flow without giving away equity. So Sheneya is going to go into so much in this workshop, but before we get started, I just hope that you are all following the People's CPA on Instagram. If you're not yet, you're really doing yourself a disservice as a founder. Go and follow them now. I've been following them, I think, for a couple of years now. And I learned so much as a founder. So before we get started, I just had to make that plug because I absolutely love following your Instagram account. Sheneya, I'm going to let you introduce yourself and get started. But before we do that, I want to let you all know that this is an interactive workshop. So Sheneya will be pausing for questions throughout. She has about 3 different sections. So at the end of each of those sections, she'll be pausing for questions. So pop your questions either into the Q&A section or into the chat, and she'll make sure to answer those throughout. And then stick with us until the end for a couple of announcements and reminders. So I'm going to kick it over to you to get started and take my face off the sting screen.
We're going to miss your face. Thank you so much, Avery, for the amazing introduction, and welcome to all the attendees of this amazing event. Number one, again, shout out to Avery for even putting something like this together. A lot of us, need this type of assistance, and especially as we're all moving towards, becoming founders that are now going to scale, this topic is of utmost importance. So I'm honored to be able to end off such a lovely series of events with this topic. So we are going to talk today about how to maximize your cash flow without giving out equity and understanding how much debt is right for your company, right? We're going to get into the topics because with each business, this answer will be different based upon the stage you are in your business, what type of business you're running, and the dynamics of your team. So we'll just hop right into it. I'll introduce who I am. So hey y'all, I am Sheneya Wilson, aka the People CPA. I am a serial entrepreneur, certified public accountant from the state of New York. I am also a real estate investor and the founder of Fola Financial LLC. I work with affluent professionals, creative entrepreneurs, and small business owners and investors, and teach them how to solidify their financial foundations and go ahead and grow their wealth in various different ways. As you can see, I also like wine and food, which is why I'm so happy in the picture that y'all see on the screen. All right, so jumping right into the topic because it's going to be very in-depth. I want to definitely make sure we leave room in between for you guys' questions. So again, as she said, feel free to drop your questions as I'm speaking right in the chat, and we'll go ahead and answer them when we take our pauses. So number one, let's first talk about understanding the keys needed to really scale a 7+ figure business. So in this presentation, specifically, I'm going to be talking about how to maximize your operating budget. Obviously, before let you guys know what an operating budget really is, how to analyze and manage your cash flow. Very, very important part of scaling your business is understanding how cash is coming in, how cash is going out, and their impacts to either your operating, investing, or financing activities. Then we'll end it off with understanding the difference between debt and equity and how to scale your business with either, right? So there's several types of business funding and business assistance for capital, but understanding what you're giving away or what you're accepting as of terms is very important to making sure you are maximizing your cash flow to scale your business. Okay, so before we jump into the context though, just want to go over your financial responsibilities, because before any of these strategies that we're going to discuss for the remaining of this presentation can be addressed, you should know that number one, you want to make sure you have adequate bookkeeping and record keeping, right? We can't scale, we can't budget, we can't cash flow plan if you don't have your books and records together. That's number one. Number two, having your books and records done will allow you to perform this financial reporting and analysis, which should be done periodically as you are a founder. As we do in our personal lives, assess our progress, we should also assess our business progress, which we do through financial reporting and analysis. And of course, business and financial planning, this goes into how you're scaling your business. What are your long-term business goals? What are some of your long-term personal goals that are dependent upon your business being successful for you to get there? All of these things matter. And of course, tax planning and tax filing and learning how to pay yourself the right way. You want to make sure you have these all noted down before we get into, okay, let's get into scaling our business. All right, so operating budget. Well, what is it? So your operating budget is an estimate of your income and expenditures for your business over a period of time, right? Your operating budget is going to tell you, hey, here's how much I'm expecting to make, here's how much I'm expecting to spend, here's how much I'm expecting to net. When you are putting together an operating budget or even your bookkeeping, you want to be very detailed with how you go ahead and categorize your revenue and how you also categorize your expenses as well. So starting with revenue, understand that all revenue is not considered to be operating revenue, right? There's certain income that you earn from your business that is taxable income, but that may not be operating revenue. So each of you should definitely detail, how am I earning revenue from my operations? Are you earning money from providing a product? Is that sales revenue? Is it service revenue? Are you in professional services? Are you earning income from subscription revenue? Are you in the business of getting sponsorship revenue? You want to distinctly know what your revenue types are, because once we get into the expenses, we want to gauge how profitable our revenue streams are against the expenses that are associated with these revenues. For example, with products and sales revenue, our corresponding expense is going to be cost of goods sold. If my profit percentage from my product versus the cost of that product is not favorable, I may consider assessing my business model to either increase my product price, decrease my costs, which we'll talk about later how to do that, or it may just be figuring out a way to diversify your offerings. For some individuals who may have products that are not super profitable in regards to sales price versus cost, you can add in a subscription, or you can add in a service, right? You want to figure out how to maximize your operating revenue. The same way they say individuals that want to become millionaires need at least 7 streams of income. Think about that with your business as well. There's several different ways that you can create multiple streams from using your same business, but understand again what your audience wants, your marketing strategy, costs associated with it will dictate to you which operating revenues you should focus on. Then here's a list of certain revenues that are non-operating, right? Because again, we don't count this into our operating budget. Operating budget, we only care about what is generated from actually conducting business operations. Some examples of non-operating revenue are going to include interest, dividends, and capital gains or losses from the sale of an asset. So if your business has any of these as income, it's still considered revenue, it's still taxable, but this does not be included into our operating budget. Very important to distinguish, because we want to make sure our operating budget is as accurate as possible, so that as you're conducting your business, you can go ahead and adjust as necessary. So I quickly mentioned the idea of operating expenses. Even with that, it dissects as well even further. So what we want to understand from our expenses in regards to our operating budget is, well, how much are our revenue streams costing us? Very important to know. If your revenue streams, again, are not profiting as they should be, we need to assess and adjust. A part of being a founder is knowing that we are agreeing to the commitment of pivoting when needed every single time, right? So let's talk about direct costs versus indirect costs, because essentially a lot of products or service may have a mixture of the two, and we want to have these costs dissected so we can see, well, which ones can I mitigate, which ones can I completely eliminate, or which costs I cannot avoid. The ones that we can't avoid, aka certain fixed costs, will have to remain in our operating budget regardless. So I'll walk through what direct and indirect costs are. So direct costs are costs that are expenses that goes directly into producing or a product or good or providing a service. Indirect costs are general business expenses that you incur while you're operating, right? So here's a list of examples. Again, as I mentioned on the previous slide, as it pertains to revenues related to sale of a product, that's going to be cost of goods sold. If you, AKA COGS, for those of you who understand a little bit of accounting, right? We love acronyms. Cost of goods sold. This can be inclusive of your raw materials, any shipping costs to get the items to you, anything that you incurred to create this product that you are now selling is cost of goods. Because what we need to understand is cost of goods is going to be a very important factor in figuring out what our gross profit percentage is for that revenue stream. Then we have cost of service. So for those of you who are service deliverers like myself, I have a bunch of clients who are lawyers, for example, and a lot of their revenues may be created from providing trademark services. But as we know, there's going to be an associated cost to rendering that service, whether it's the direct cost of the trademark application, or it's the cost of the person who's actually doing it for you. So it can also include direct labor and direct materials as well. These are direct costs. A lot of times, these costs we can't avoid. These costs we can, however, minimize, right? Because these are going to, again, affect how profitable we are per that revenue stream. So whether it's your products or your service. Then we have certain indirect costs, right? These are costs not directly related to your revenue streams, but are needed to be incurred in order for you to operate, right? So think of rent and utilities. Well, without my house and my Wi-Fi, I can't work from home, right? So that's an indirect cost. Doesn't go into towards my service or products, but it does need to be incurred in order for me to operate. And then we have other selling and general administrative expenses, which can be your admin team, if you have any other support, as well as advertising. This is all indirect costs. Advertising, for example, is a cost that we need to incur because people got to know what we're selling, right? However, that's not considered a direct cost because that does not directly go into the good or the service. But it's still included in your operating budget because advertising, paying rent utilities, paying salaries and contractors expense, and paying for softwares are expenses that we need to incur to operate, right? So staying on this slide, as you can see this list of expenses, which can go on and on and on, there's thousands of tax deductions and the expenses that we incur as business owners. When you are creating your operating budget, you want to understand which of these costs are fixed costs and which of these costs are variable costs, right? Some of these costs are going to be fixed. Like, so for example, rent. Every single month, if you're paying for office rent, you know exactly how much you're paying every month, right? And if you have a full-time employee, you know exactly how much you're paying every month. And if you have like utilities that's super fixed or software that's fixed, that can also be fixed costs, right? Variable costs, of course, that fluctuate. So utilities may be, right, variable costs because if you use less electricity, your bill will be lower. If you use more electricity, your bill is going to be higher. So when you're creating your operating budget, understand the role of each of these costs, right? The goal is to always understand your fixed costs. And with most clients, I try to advise them on, at a minimum, your fixed revenue, which can be subscription revenue, which can be contract revenue that you have a promise the client's going to pay month over month over month. That should cover all of your fixed costs at a minimum. We would love if there's a surplus of, okay, here's my fixed revenue, my subscriptions, my contracts, and I know that my fixed revenue also covers my fixed expenses, and I have a surplus from that. That is an optimal situation. Because now if you make variable revenue, right? If you're doing one-time speaking gigs, or you're doing one-time e-products, or you're doing one-time service offerings, those are variable revenues. However, all that's going to do is add a plus to your operating budget. This means that, again, I was able to figure out how much I needed to make to cover the cost that I know I have to incur, figure out what a comfortable cushion is going to be between the net from that and what I need to pay. But I also want to make sure I am understanding that if I want to go ahead and continue to grow and scale, I want to figure out other ways of earning revenue that are going to be a surplus to me, so I can utilize that capital to implement in different aspects of my operating budget, right? So say we over budget now because we earned extra 10K this month from doing a partnership with Capital One, for example, right? I can now go ahead and think about taking that extra 10K and allocating it to various aspects in my operating budget, whether it be prepaying rent so you can get a little bit of a more cushion. That's one example. Hiring, right? Increasing salaries and contractors to a hire. That can also be advertising, investing in a software, investing in equipment. Again, the moral story, you want to make sure that you understand the role that your revenue has towards your expenses and how both of them are going to be interacting to create your operating budget and provide you insight into the performance of your business. So again, this can't be done without bookkeeping, because we need to be able to know, well, what expenses are we currently incur and what falls in what category. The reason why we take a look at your operating budget is so that we can be able to, again, give you some insight into how you're performing. So here are some ratios that can be created from, again, with proper bookkeeping, proper financial reporting, we can figure out certain things. So wouldn't it be great as a founder to understand, well, how much cash am I generating per dollar of revenue, right? So here's one calculation of cash flow to revenue. We have other ratios that can be your cash return to assets, right? So based upon the amount of assets that I have, how much cash flow am I generating, right? I also want to know, well, okay, I have debt too. So how much of my cash flow is allowing me the ability to properly pay my debt on time? That's very important to know, because a lot of times as entrepreneurs, we are so focused on the income statement, right? How much did I make? How much did I net? That's all I want to know. Not true. You also want to pay attention to your balance sheet, right? You want to know, well, what's your impacts of your assets on your cash flow? What is the impact of your liabilities on your cash flow? And what is the impact of equity on your cash flow as well? All very, very important topics to know. So I do want to pause here because now we're going to get a little bit more into depth in regards to cash flow. So Avery, feel free to pop on if we have any questions.
Yes, just so y'all know, you can ask questions throughout, pop them in the Q&A section or in the chat. Danielle had a great question, and that is, what would be considered investments or assets for a product streamlined business?
What would be, can you repeat, please?
Yeah, what would be considered investments or assets for a product streamlined business?
Great question. Mm-hmm. So for example, with your product based business, if you are creating your product like from home, a lot of times we see entrepreneurs purchase assets pertaining to operations. So you can buy, for example, a machinery, right? That's helping you produce your product. So if you're making like skincare products, a lot of these entrepreneurs are buying machines that do a lot of the production. That machine is an asset that's going to lay on your balance sheet, right? So now, for example, somebody is coming up after you and they want to start a business, what you're doing, and you sell them that asset, right? You're going to have a gain from the sale, because hopefully we're selling it for more than we bought it for, right? We'll have a gain from the sale of that asset that is now going to be our non-operating revenue that we generated.
Such great examples. I believe that's the only question that wasn't answered already yet. So again, ask questions at any time and we'll ask those throughout. So I think we're good to keep going.
Perfect. Okay. So now we'll get into understanding cash flow analysis, which is my favorite part of working with entrepreneurs, is helping them understand their cash flow, right? So what is cash flow? So cash flow is how your money flows in and out of your business. But more importantly, we want to see what buckets are this cash is it flowing into. Is that cash flowing in or out of operating, right? Is that cash flow coming in or out from investment activities? Is that cash flow coming from financing activities, right? So let's explain what each of these things are. So operating cash flow is going to be either the cash that comes in or out of your business's account for day-to-day operating activities. So think revenue, think expenses related to revenue, overhead, all that stuff that we just discussed, right? However, now again, what if you have an asset, right? We just talked about investing. So now we also have cash flow from investing. We want to see, well, if we're purchasing investments, because your business, just like you, if you want to invest in stocks and bonds, your business can also invest in stocks and bonds as well. And it may have some non-operating revenue from investing, right? That's going to be cash flow from that. So, and then lastly, we have cash flows from financing activities. So this has come to how we're either receiving capital investments or how we're paying back capital investments. And the goal of cash flow analysis is to see how cash moves from each of these buckets, either thoroughly in one bucket or in between several of them, right? Because as we know, cash flow from operating may be utilized to go ahead and buy an investment, which would mean that cash flow from operating now has been touched and is moved into investing. Or cash flow from operating can be utilized to pay our expenses for having some capital borrowed, which can be interest expense, loan origination fees. So we'll see a movement from cash flow from operating to a cash flow to financing, right? This is very high level stuff. My background is in corporate, so I'm so super used to this, but as small businesses, as you grow, you do want to analyze, again, how these things are related. So once we have excess operating cash flow from capital expenditures, that's going to be considered free cash flow. This is going to be calculated separately than the cash flow statement. And your free cash flow measures your liquidity. Very, very important. We all hear about the term being liquid in personal finances. Being liquid in business is also very important, right? So your free cash flow shows investors, well, here's how much I have left over to reinvest into my operations. So we take your net income, we plus non-cash changes, we add our interest, and we less capital expenditures and working capital expenditures, and that's going to give us free cash flow. Investors would love to know this because, again, that'll dictate, here's how much excess cash you have to go ahead and reinvest back into your business in hopes that we're going to take that and scale up. All right, so I want to take a pause here as well. If anybody has any questions about cash flow before we move into business funding, which is going to be the bulk of the remainder now that we understand our operating budget and what cash flow analysis is.
Yes, I think we're all on board and ready to move to section number 3.
Yay. Okay, cool. Great. All right, so business funding. I'm going to spend a lot of time. I think I have like 10 slides on between business funding, debt, and equity because these are very, very, very important. Right, remember, the goal of this presentation is to teach you how to maximize cash flow without giving away a lot of your business or understanding, again, what type of debt we should be looking for. So essentially, again, we talked about operating budget, right? A lot of times, if you want to have better profit margins, that can be done so by leveraging outside capital, right? So imagine if you're getting cost of goods. So if I'm a product-based business, for example, and it costs me $10 per product to get my cost of goods, my stuff here, based upon quantity. With most suppliers, for a fixed quantity, it'll be one fixed price, right? So how about if I know that I'm selling this one product pretty much forever, the more I buy quantity-wise, the lower my cost of goods sold is, the higher my profit margin. Well, if I don't have enough capital to buy, 1,000 or 2,000 products at once and lower my cost of goods down to being $8 or $6, because I don't have enough, free cash flow yet, what you can do is create some, create some additional capital by leveraging different types of business funding opportunities. I love this page. So hopefully you guys will receive a copy of these PowerPoints, but definitely understand all of your funding options. Most people think that equity or debt is the solution, but there's several options on how you can obtain some type of financing for your business. So some short-term examples are going to include, well, no, let's ignore number one. We're not about to overdraft from the bank, right? I don't know what's there. If you have to, you got to, but let's not do that. But what's very popular is receivables financing. A lot of the clients I work with who are in trucking, or industries where you have a very delayed time in receiving your receivables, you can do receivables financing, where basically a company will take your receivable for you and give you a lot of that money up front. And basically you pay them a fee between how much you receive and how much you're going to get, right? If you are in need of cash right now, this is a great way to get some quick financing without going the debt or the equity route, right? I'm just using my current receivables to help finance my operations. Great thing to do if you are in need of cash right now and you have a bunch of contracts and invoices that are outstanding but have yet to be paid. You can essentially go ahead and we call it factoring. So you can go ahead and factor those contracts and invoices and then get that money right now. So a great thing to know. Then we also have trade credit and credit cards, right? So trade credit can be negotiated with different vendors, and it can be specific term times, right? Some vendors allow you to do a net 30 or a net 15 or a net 60. Well, guess what? By pushing away your expenses for a period of time, you now have a little bit extra capital to operate off of, right? So this can be very, very helpful. Same thing with credit cards, same type of example. Why dip into getting a loan if I can just leverage business credit card? And again, it'll free up some of my need to pay off anything right away, but allow me to pace myself now and continue operating without being tight in cash. You want to make sure you're monitoring how much free cash flow you have from operating. Now we have some medium-term options as well. So there's term loans. You can get a loan for your business for as little as, term loans can be as even short as 1 month, a couple weeks sometimes either. But you can get a term loan, which is again going to be, so short term is going to be considered anything less than 1 year. So you can get a term loan for, a week, a month, 3 months, 6 months. Most common is typically 6 months or even up to a year, meaning that you now are getting some capital that you have to pay back within a specific period of time. Other thing is, rather than paying for things in bulk, some things that entrepreneurs can do is, rather than paying for things in bulk, let's finance, right? So if I need to buy a truck, for example, rather than paying $60,000 to buy my truck right now, how about I finance that truck? So I can make money from that truck right now, but put my costs over a period of time, because the goal is to have more free cash flow so we can reinvest back into our operating. And hopefully that truck, by the time we're making our, our third or fourth payment, we've done enough marketing, we hire truck drivers to the point where we have enough revenue to maybe go ahead and finance another truck, right? Most of the world's biggest businesses are operating off of funding. Walmart, for example, they finance all their goods up front and then pay it later, right? Because again, free cash flow is very important. Walmart has so much debt, maybe one of the largest companies in the world that has a lot of corporate debt. But again, having debt is not a bad thing when you understand what debt is supposed to be for. The whole goal of debt, right, is to help maximize your cash flow. I can take out debt if it's going to allow me to have a lower cost of goods or cost of service, so I can increase my profit margins in the short term and ultimately even more in the long term as well. We also have government grants, project financing, as well as options for short-term funding. There are a bunch of grants out there. I highly, highly, highly encourage you. most founders have in their head that grants are only for not-for-profits, but there are several grants for for-profit operating businesses as well, or certain government programs that you can be a part of to get certain grants. This is again going to give you an opportunity to have a little bit extra capital so that you can invest into your business and go ahead and increase that amount of free cash flow that you have. Then long term, we have share capital. So again, you're giving out a piece of your business. Venture capital, essentially they're giving you a big investment, but they're looking for not only a return, but maybe a percentage of ownership. We also have angel investments. Most angel investors don't ask for equity. They maybe ask for a return on investment. Some of them may ask for equity as well. We also have long-term bank loans, which is going to be a loan again for more than 1 year. If you haven't already capitalized off of the EIDL loan for COVID relief, or any of these other loan programs that the SBA is doing, definitely take advantage of that as well. They are created for entrepreneurs like us. We also have mortgages. Again, another way for you to minimize costs in the short term is by, rather than buying the full asset right now, if you need a commercial space, you can go ahead and just get a mortgage. Therefore, you're paying a percentage, month over month. We have debentures, bonds, loan stocks, and retained earnings. So again, just more long-term ways of finding business funding. There's actually a lot more. This is a great list, but you always want to speak to a financial professional or a person who works like in banking to figure out, well, okay, based upon my size of business and how I operate, what type of funding can be available for me? Okay, so before I get into equity and debt, does anybody have any questions?
Yes, we had amazing questions come in actually. Hope asked what the difference between free cash flow and net profits are. Is there a difference?
Yes, it's a difference, and that's a great question. Okay, so net profits is only taking in consideration your income statement, right? So that's just going to be your revenue less your cost of goods. We'll get our gross profit, we'll have our operating expenses, and then we'll have our net income, right? This does not take in consideration some certain items that are left on the balance sheet part of your financial statements, right? Which can be, okay, well, how much of liability do we have? What credit cards do you owe? What trade lines are coming up to be paid? What leases are going to be paid? What investors we got to pay back, right? So these other financing options are not considered in your net income. That is considered in your free cash flow, right? Because again, cash flow is a separate statement from income statement and balance sheet. Your cash flow statement actually is going to be your way to see the relation between how transactions move either from your income statement to your balance sheet or vice versa. That was a great question.
Thank you so much, Hope. We had another question come in from Jasmine. Jasmine says, as an e-commerce retailer that sells other brands' products, do you have any recommendations on how to reduce my COGs?
Yes. So again, the easiest thing that you can do is buy in bulk and negotiate with your vendor a lower cost. That's definitely one way. Other ways is just to either find another vendor, right? I'm trying to think other ways to decrease cost of goods. Really, it's just getting the cost lower. So you may have to negotiate if you can negotiate up front, or if again they offer you discounts for buying more quantity, that'll allow you to decrease your cost per unit as well.
Yeah, negotiation, that's such a great tip right there. We had someone ask who's a retailer who had applied for grants before, who has not gotten that many. Do you know if grants for retailers is a common thing or not?
So grants for everyone is very common, but obviously with grants, it's as applying for college, similar thing, right? There's going to be 10,000 applicants and maybe going to take 1,000 people, right? So never get discouraged and never put all your eggs in one basket. So I would say you should definitely research grants within your state. Those ones are typically easier to get and I heard that from one of my grant friends. There's a lot of state grants are not access. Most people look at government grants or private grants, but there may be some grants for you in your state. So I would say don't get discouraged. If needed, you can definitely also hire like a grant expert, a grant writer, somebody to, because most grant writers or grant experts, they have a database of grants that will be specific to your industry.
Such great tips. I hope that was helpful, Jasmine. Okay, I think we're caught up on questions and can keep on with the information.
Perfect. Okay, great. All right. So I love the title of the slide, Pay Me in Equity. Beyonce is one of my idols, love her to death. And once she said this line, like, pay me in equity, right? It started spurring a whole bunch of conversations about what equity is, right? So equity represents ownership. That's why we pay me in equity. Rather than give me a check for my work, especially that's something that I'm creating or helping to create, I want a piece of ownership, right? Which is why with investors, for them to give you $1.5 to $3 million, you know, I'm gonna want a little piece of it because I invested heavily into your dream as well. So, you know, that's pretty much where the conversations around equity spur from. So equity compensation can be paid to employees, and equity compensation that will essentially allow employees to have options to exercise restricted stock in the near future. So a lot of companies like Peloton, Spotify, a few more of these fintech companies that are also starting have so much clients that are having like these huge equity cash outs, right? Well, the company looks at it this way. The reason why you vest to exercise your equity is because they want to see, well, how committed are you to my organization? How committed are you to our dream? If you can show me that you can, you know, stay down and commit for 5 years and contribute to the growth of our organization, I'm going to give you a piece of ownership, which you can hold forever, or you can cash out, exercise, trade, do whatever you want with it. And that's what equity compensation is to your employees. Now, to investors, equity compensation works very similar, but again, this will depend upon certain things. So before we kind of tap into the investing part, I want to ask you all to think about this question. How much equity should you give out for investments, right? I see a lot of founders struggle with this specific question. They'll say like, hey, somebody wants to give me 100K for 15% of my company, right? And it's like, okay, from 100, 15% sounds like a small piece of it, right? But if your business is worth $100 million, 15% is a lot of money. A lot of times, founders do not know what the actual worth of their businesses are. And you don't ever want to give out or promise equity without assessing, well, how much is my business worth today? That is the most important piece. The way the stock market works is, you know, when companies report their earnings, either daily or period per quarter, or there's news about the company's earnings or what they're doing, their products and services, you will see the stock price of that company either go up or go down, correct? But it's going from a foundation number. To go up or down, we had something there. A lot of us don't have nothing there. We don't know what that number is yet. So how can we, you know, foresee a future of, okay, this is how much my investor is going to be receiving in 10 years. It may make you very uncomfortable to give away even 5% once you realize how valuable your business is. So how do we figure out the value of our business? It's called a business valuation. So a business valuation is going to determine the current economic value of your business or a unit of your company, which is also very important to know. So say, for example, I'm an accountant. If I want to get a partner to come on board and work with me just on my tax out of the business, I will get a valuation just for the tax out of my business, because I also do accounting, I also do consulting, but I may bring on a partner for tax prep, right? For tax advisement, all that good stuff. Well, how much ownership am I willing to give up? I need to know the current economic value of what my business is worth, but also with valuations, typically we are going to go ahead and project either for a period of 3 years or 5 years to know how much your business can be worth in the near coming future as well. Because again, know how much you're worth now is one thing, but know how much you can potentially make is another. Because you may be scared, like, giving somebody 10% of $100 million, That's a lot of money, right? So again, you want to go ahead and value. So it's going to be evaluation is determining the fair value of your business for a variety of reasons. So like this can help you with understanding your sales value. It can allow you to again establish partnership and how much interest you'll give out. It also helps with taxation, and also for people who are like divorced and their business is intertwined in the divorce proceedings and how much they should pay for the business to separate. The valuation is going to be needed as well, which is a fun fact, right? So again, before we give out equity, understand how much your business is worth now and also how much your business has the potential to earn in the near future. All right, so that's equity, right? That's that part. And now let's talk about business debt. Never be afraid of business debt. So many people are like, I don't want debt. But again, I explained to you guys earlier, debt can allow you to free up your cash flow a little bit quicker or increase your net income, increase your operations investment real quick if you use debt the right way. So debt is not a bad thing because number one, aside from equity, with debt financing, you're not giving out ownership. Typically with debt, you are going to be paying some fees though, right? You're going to have to pay like interest, loan origination fees, etc. But these things are all actually tax deductible, right? So debt financing is a great thing to take advantage of. Again, as long as you understand the purpose of having that debt and making sure you're maximizing the utility of having that debt on file. And other ways for you to, use debt financing, you don't have to get a loan, which is what the first law was kind of alluding to. You can also take advantage again of credit and lines of credit. So credit is going to be, what you use to obtain goods and services. You can get a credit card from your bank, a credit union, another type of, financial intermediary institution, etc. But then you also have the option of doing a line of credit. A line of credit is essentially a mixture between credit card and a loan. A lot of times with your banks, and if you have a good relationship with your banker, you can get a good line of credit without having to worry about, number one, guaranteeing it with your personal credit, which is what we always want to avoid as we grow our business. And number two, with lines of credit, again, depending upon your relationship with your banker, you may be able to negotiate really good rates or terms for you to, again, leverage that credit in the intermediary in hopes that in the future, we're going to be operating just enough to go ahead and satisfy our debt, but have a lot more free cash flow to go ahead and reinvest back into our business. Okay. So this is my last slide, perfect timing. Before we hop into a last Q&A session, is understanding other ways to maximize your cash flow, right? So we talked about leasing versus buying, or again, if you can't lease for certain things, well, let's see if I can get some type of trade credit, a net 30 account, a net 50 account. Sometimes also offering early payment discounts to clients. I'm a service-based business myself. So, clients don't pay all the time, right? And I have a bunch of AR and I'm like, oh my God, this is crazy. But to encourage, if you need to free up your cash and get some more cash in your pocket, you can offer some of your customers early payment discounts. Okay, I'll do a net 15 invoice. If you pay me within the first 10 days, I'll discount it, by 20%. That's a way for you, again, if you need to get more cash and capital to operate, one thing that you can do. Obviously, lowering cost of goods and cost of service. This is going to increase your gross profit percentage, which will allow you to have a higher budget for the remaining of your operating expenses. And of course, diversify your product and service offerings. So see if with your product that you're currently offering, can you tag something else to it, right? Can I upsell them an ebook? Can I upsell them a membership? Can I upsell them, a conversation with me? Or can I, figure out just new ways to serve these same clients? There's so much that you can do if you just take a time and look into what your audience or your clientele are looking for and how they like your current product or service and what else you can do to, just basically dig a little bit more in their pockets, right? And have them buy some more of your stuff. That's going to definitely help you maximize cash flow. And of course, last but not least, you want to create and manage your business budget, right? just like we budget personally, well, we should be budgeting personally, when we're making, conscious decisions about our spending based upon our income, same thing we should be doing with our business. I encourage everyone to create a business budget, an operating budget. So you can see again how profitable you are per revenue stream. You want to be able to see, well, how much are your employees costing you? It'll be great to even break it down even further to see if you do have employees. Well, if I, put a price on service and it's taking this employee 6 hours to complete and I'm paying them $20 an hour, am I charging more than 120 to have a good, healthy product profit margin for that piece of service, right? So cost of goods for product-based businesses, again, for service-based businesses, it'll be cost of service. You want to make sure that your gross profit margin for all of your revenue offerings are maximized, right? So always, again, be very, very aware of your spending. A lot of entrepreneurs get in the habit of just like making money, spending. But you'll see once you tighten down on your numbers, your profit margins are going to increase because you're going to get hyped. Like, oh, shoot, I see myself making an extra 10% per month over the next X amount of months because I was able to secure some financing, increase advertising, and bring on one more employee, right? These are the decisions that corporate execs are making to take these $10 million companies to being $1 billion valuations. They are very intricate and detailed with the number, and they thoroughly understand what's it costing to go ahead and render the service or to deliver this product. And that pretty much wraps up my presentation, again, about how to maximize your cash flow without giving out equity, and understanding that you have several options in regards to seeking remedies to help you have a little bit more capital on hand to go ahead and increase operations efficiency. And thank you for having me.
Yes, we had a great question come in from Jasmine, and that is, where do you recommend as a starting point to create an operating budget when you've never done one before or had one before?
Yeah, so starting point is definitely having your bookkeeping done, right? We need to see at least where you are, and that's going to be done by bookkeeping. So you can leverage softwares like QuickBooks, there's Wave Accounting, there's FreshBooks, so many platforms that you can utilize, or handy dandy Excel sheet works as well. But before we talk about budget creation, we need to have your books and records all the way together.
Yeah, that's such a good point. One last question came in from Sheila, and that is, can you go over the difference of restricted stock and common stock, just as your kind of 1 or 2 sentence breakdown of the difference between restricted stock and common stock?
Yes. Okay, perfect. So common stock is, what many of us, if you are an investor, you buy and sell, like securities, that's what we're trading. Common stock. All right, that's what's here, right? Restricted stock. So, all right, when a company is created, they're gonna have a fixed number of shares. They can also increase or decrease, right? But typically, let's say I start off with 1 million shares, right? From that 1 million shares, I do not have to make all of those shares be issued. So we can have 1 million shares authorized, meaning that I have the capabilities of issuing 1 million shares. However, I can only choose to issue 600,000 of those, which means I have 400,000 left in non-issued shares. With those non-issued shares, that's typically going to be our basis for restricted stock. This is the shares that we put aside just for our team, for our CEO, for our CFO, for our employees. That's what they're going to be leveraging, right? So again, the shares are issued, but they're not going to be like traded on the stock market. So similarly, it was going around yesterday that Mark Zuckerberg, he sold, well, basically used some of his restricted stock that he had. He sold, I think 100,000 shares, something like that. Again, understanding that that's not directly impacting investors, since it does impact investors because he sold it to the stock market. But the shares issued to him, if he does nothing with it, it does not impact investors unless he exercises them, right? So again, most common stock shares are going to be traded randomly. Restricted shares are going to be shares that we have issued, and they may be held by our team, our employees, but those people have the right to choose when they want to exercise those. Once they exercise it, it's now included in the count on the shares that we utilize in the stock market. So like when CEOs share a big chunk of their shares, it can have a big negative or positive increase on the stock market, because again, we're moving it from being restricted and like, again, not traded to now it's being traded. Great question.
Such a great question, Sheneya. That was beyond insightful and beyond helpful. Everyone is saying thank you in the chat and has throughout this entire event. For those of you who want to go back and re-listen to this event, keep your eyes on your inbox because we're going to send a link out to all of the event recordings. Sheneya, if you have a moment, I'd love for you to pop your link into the chat so people can directly access that. Also, go to the People's CPA on Instagram. All of their information is easily accessible from there. And then for those of you who would like to join the 10th house or learn how to join the 10th house, we have free and paid membership options with monthly payment plans. So head to femalefoundercollective.com to learn more about our membership. Also sign up for our newsletter if you would like to be included in our holiday gifting opportunities. So that's an exciting announcement. And we have holiday gifting opportunities coming out soon. So join our email newsletter to find out how to be included in that. Thank you everyone for joining. Thank you so much to Capital One Business for partnering up with us for this event. This has been amazing. Sheneya, you are so wonderful. Thank you so much for your time.
Thanks for having me, and I'll see you guys soon. Thank you so much, Avery, for putting this together. Definitely need it. So I hope you guys learned all that you need to learn.
Yes, thank you so much. We'll see everyone soon. Bye.